The Federal Reserve just cut interest rates again, and on paper that sounds like good news. Lower rates usually mean borrowing gets cheaper and the economy gets a little breathing room. But here's the surprising part. A lot of people aren't actually feeling that relief yet. Their credit card bill still hurts, their mortgage rate hasn't really moved, and their savings account looks basically the same. And guess what? That disconnect is exactly why this decision matters more than it seems. Today, I want to talk with you about what this rate cut really means for you, your money, and the choices you're making every day. Also, there's a detail I will cover later on that almost nobody talks about, and it might change how you think about saving and borrowing right now. Before we keep going, I'd love to hear from you down in the comments. When you hear news about interest rates going up or down, what's the first thing you worry about or hope will change? It could be anything: loans, rent, savings, or just the cost of living in general. Let me know, because reading those comments really helps shape these conversations. So, let's talk about what actually happened. As we're closing out 2025, the Federal Reserve lowered its main interest rate again. This is the third cut in a row, and now that rate sits between 3.5 and 3.75%. Since the Fed started cutting back in September of 2024, rates are down about 1.75 percentage points. That's a pretty big shift when you zoom out. But, and this is important, lower Fed rates don't magically flow into your life overnight. You see, the Fed controls a very specific rate, basically what banks charge each other for overnight loans. Everything else, mortgages, credit cards, savings accounts, those are more like cousins of that rate, not direct copies. So sometimes they move fast, sometimes they drag their feet, and sometimes they barely move at all. Now, behind this latest decision, there was a lot of disagreement, and that doesn't happen often. The vote was 9-3, and that's one of the most divided meetings we've seen in years. Some officials wanted a much bigger cut because they're worried about jobs. Others didn't want to cut at all because they're still nervous about inflation. And Fed Chair Jerome Powell acknowledged that split, basically saying people had strong opinions, but also respectful debate. That tells us something important. Even the people setting policy aren't fully sure what the next few years will look like. And speaking of uncertainty, inflation is still hanging around. It's lower than the scary highs we saw a couple years ago, but it's not back to the Fed's comfort zone. Their preferred inflation measure is still sitting around 2.8%. That might sound close to their 2% target, but in Fed world, close isn't close enough. Some economists are warning that getting from here to 2% could take a long time, especially with tariffs, global tensions, and higher costs baked into the system. At the same time, the job market is starting to show small cracks. Unemployment ticked up to about 4.4% earlier this fall, the highest we've seen in a few years. Now, that's not panic level, but it's enough to make policymakers nervous. So the Fed is walking a tightrope here, trying to protect jobs without letting inflation flare back up. So then you might be asking, okay, that's all interesting, but what about me? What does this actually mean for my money? Well, let's start with savings, because this one confuses people the most. Many big banks are still paying almost nothing on regular savings accounts. That hasn't changed much, even with all these rate moves. Online high-yield savings accounts are better, but they've come down too. A year ago, you might have seen rates around 5%. Now, many are sitting closer to the mid-3s or low 4s. So yes, the rate cut does matter here, but you're still earning more than inflation if you shop around. And that's the key point: shop around. Also, money market funds have dropped more noticeably. They were around 5% last summer. Now, they're closer to 3.7%. Still not terrible, but not as exciting as before. So if you've been parking cash there, this is a moment to reassess and make sure it still fits what you need. Now, speaking of things that surprise people, Treasury bonds have stayed pretty attractive. The 10-year Treasury is still yielding a bit over 4%. Municipal bonds too, especially high-quality ones, are offering solid returns, and in many cases that income is tax-free. That's something a lot of cautious investors are quietly leaning into right now. Okay, now let's talk about borrowing, because this is where expectations and reality really collide. Mortgage rates haven't fallen much at all. A 30-year fixed mortgage is still hovering around 6%, give or take. And people see the Fed cut rates and think, shouldn't mortgages be way cheaper now? But mortgages follow long-term Treasury yields more than the Fed's short-term rate. And those long-term yields have stayed high because investors are still worried about government debt, inflation, and what comes next. And credit cards are another pain point. The average interest rate has dipped slightly, but we're talking maybe 20.8% down to 19.8%. That's still brutal. If you're carrying a balance, that tiny drop doesn't really change the math. And this is where I'll pause and say, if you're able to explore a 0% balance transfer, or even call your credit card company and ask for a lower rate, that can sometimes do more for your budget than any Fed decision. Auto loans are similar. Rates have eased a bit, but not dramatically. And with car prices still near record highs, a lot of people are borrowing more than ever just to get a decent vehicle. That combination is tough. One small bright spot here is home equity lines of credit, or HELOCs. Those rates have come down more clearly from the 9 to 11% range down closer to the high 7s. For homeowners who need flexibility, that's something worth paying attention to. Now, let's zoom out for a second. Financial markets actually like this rate cut. Stocks jumped, bond yields dipped, and investors seemed relieved. But interestingly, they didn't see it as a sign of endless cuts coming. They heard something more cautious. Powell basically signaled, we're cutting, but we're watching closely. No promises. And here's where politics enters the picture, because Donald Trump has been very clear about preferring lower interest rates. He's criticized the Fed before, and with Powell's term ending in 2026, there's already speculation about who might lead the Fed next. Markets are watching that closely because leadership matters when it comes to how aggressive or cautious future rate decisions might be. So what should you do with all this information? This is the part people really care about. First, don't assume lower Fed rates mean instant relief. If you're waiting on cheaper loans, patience matters. Second, take a hard look at where your cash is sitting. If your savings is earning nothing, you're probably leaving money on the table. Third, if you have high interest debt, especially credit cards, that should still be a priority. The Fed cutting rates doesn't solve that problem for you. Another thing to consider is expectations. A lot of folks thought rates would fall fast and far. Right now, the Fed itself is projecting maybe one more cut next year, maybe another after that. They're talking about settling into a neutral rate around 3%. That's not zero, and it's not free money. It's more like normal, at least by historical standards. And speaking of history, this is where I'll tease that point I mentioned earlier. The Fed has been here before, trying to balance inflation and jobs. In the 1970s, stop and start policies ended up letting inflation stick around longer than expected. That's why policymakers today are so cautious. They'd rather move slowly than risk repeating that mistake. That caution is frustrating, but it's intentional. So yeah, when headlines say the Fed cuts rates, it's not wrong, but it's incomplete. The real story is how slowly and unevenly those cuts filter into everyday life. Some people benefit sooner, others later, and some not much at all. Now, let me ask you something. When you look at your own finances right now, does it feel like things are getting easier, harder, or just different than you expected? There's no right answer. Sometimes even understanding why things feel stuck can be a relief. And as we keep moving forward, here's the mindset I'd encourage. Focus on what you can control. You can't control the Fed, inflation, or politics, but you can control where you save, how you borrow, and how informed you are. Small adjustments, choosing a better savings account, paying down a high interest balance, those add up over time. I'll keep coming back to this topic as things change, because clearly this story isn't over yet.